90% of traders trade trends, but most traders don't understand what the higher time frame context is saying to actually drive and power those trends. So they place trades without that context, and honestly, it's a gamble whether they're going to pay off or whether they're going to get stopped out. So I want to show you exactly how to get into high probability trades like this 2R and this 3R on AUD NZD that simply used our trend in line with higher time frame context. So let's just get into this. So first and foremost, I'm trading 12-hour price action. So we're looking at swing trades. And if we're looking at this price action in isolation, yes, we can see some broad trends in the market. We have higher prices, we have a pullback, and then we have higher prices. So you could argue there's a bullish trend. However, we don't really get a view as to where our swing points are. I mean, straight away you can see if that's suddenly your swing point and you get traded through. Are we shifting trend? What constitutes a trend continuation? So in isolation, this price action can tell us a certain amount, but not that much. So what we need to do is combine this price action with higher time frame candles. So I'm going to overlay first and foremost the monthly candle, because I want to understand what the monthly candle is doing in context with my 12-hour price action. And what I see here is that in this entire candles range, from this area here to this high, this is the entire monthly price action printed in one candle. So it's very bullish price action. So when we start to see a retracement, we can see where is that retracement coming from? Well, it's coming from this high, which is the previous month high. So let me just make that a bit clearer. So we have price breaking into the external range liquidity at this high and then reversing. So in terms of a trend, we have bullish monthly candle, and now we're seeing a retracement. But what can we learn by just combining additional time frames? So if I just leave that there and I take away the monthly candle, we know we're reacting from the monthly high. Then we can look at the 2-week candle. And what we see is that price broke above the previous 2-week candle range right here, and then actually closed inside its range. So now we have competing confluence. In one sense, we might be going higher because our monthly candle printed bullish. But in another sense, we've swept the monthly high. We've also swept a 2-week candle and we've closed inside its range. So there's an argument to say that price may want to target the opposing end of this 2-week candle. But that's not really what the month was telling us. The monthly candle was saying we're bullish. Okay, so we have competing confluence. Then what we get is actually an opposing sweep. So price does shift bearish as we saw, and it sweeps below this 2-week candle's low. So price trades into the low, and then we see some consolidation, and eventually price closes right here inside this candle's range. So now we have new context, which is that price is most likely going to want to target a continuation or the high of the candle that it is swept and closed within. So we have accumulation, manipulation, and then price wants to distribute. So now we can go down a time frame and look at what's happening on the weekly time frame. And here you see something very interesting. Price actually swept this weekly candle range. So if I track price action, we have bullish price action into the monthly liquidation. We create a bearish weekly range. Price then respects this range, trades lower, and raids the external range liquidity at the low of this weekly candle. We also close inside of this weekly candle, which exposes the high, the same target as our higher time frame drawn liquidity. Then what we see is some consolidation. So price tries to go higher. We then get a sell-off. This is just inducing liquidity into the market. We then get the trend taking over. So we get our first sign of bullish momentum. We trade back into the internal range liquidity, and then we break out. And then we have confirmation that a trend is emerging that we can trade towards, firstly this high, but then a continuation of the monthly candle. And that's what happens. We see price trend upwards and price moves higher. So how do you actually trade this? Well, the main thing you have is a 2 week, or we just move back to the 2 week, a 2 week CRT in play, where we have accumulation candle, we manipulate below the low, and then we're trading back to the high. So you can wait for this candle to finish printing and then simply get involved here in this first acceleration of the trend. Equally, you can get involved slightly earlier by waiting for the weekly close. So as soon as this candle closes, we have raided the external range liquidity at the low of this candle, and we can now target the high. So if you want to take that entry, you need to wait for an order block. So now I'm just going to take all of this away and we can map our price action. So we have bearish price action into the liquidation, and then we have a shift higher, new order block right there, 12-hour order block. So let me mark that zone so it's very clear. It's this entire last sell before there's buy pressure in the market. So you can take your order from the high of this candle, covering the low, and target the extension of the trend. And this plays out for a 2-hour trade. Yes, you have to experience some drawdown. This is purely manipulation. Price eventually takes off. Your other option is you just wait for the 2-week candle to finish printing. So we have this confirmation of the liquidation of this low. Then we see a very clear shift in the market. So price moves from bearish to bullish. It disrespects this bearish fair value gap, tries to go lower, and then breaks higher. We have a true market structure shift at this level here. And then we can track how internal range liquidity is starting to form. So we get the formation of a new 12-hour order block at the extreme of the range, the last sell to buy. And then importantly, what we also get is a new fair value gap, an inefficiency in price between, let me take this away, candle 1, this candle, expansion candle, candle 2, the inefficiency between the wicks, price trades in and away. So we can simply take an order from the fair value gap and cover these lows. To hit our first target, we've got a 1.78R, which is great. But then we come back to how do we confirm via timeframes? We had bullish close, we've already swept the high, and we're shifting bullish. So price just wants to go higher now. So we can just literally track our take profit below the swing points that emerge in this leg. So we just trail it up all the way. We go there, and then eventually to there. And that would be logically where we'd probably get stopped out, 3.27R. So that is how to ride trends in the market, but trends that make sense, that trade in line with higher time frame candle closures. So what is a market trend? Trend identification is the process of determining market direction across multiple time frames by analyzing whether price is respecting highs and breaking lows, or breaking highs and respecting lows. The added bit here is that it needs to be in context with higher time frame candles. Most traders are just looking at a single time frame, so they're just executing based on price action, or maybe they're looking at one higher time frame candle, maybe the monthly if you're swing trading, but you're not getting the full picture. You need to combine those time frames. Why does it matter? Because good bias leads to good trading. You can get a lot wrong. If your bias is good, you're going to win more trades. So how do you apply this? Identify candle range to identify higher time frame draw. So use monthly, 2 weekly, weekly candles, as I've just done, to understand what's the most logical next phase for price. Analyze intermediate time frame for reaction points. So this is your 2 week, your weekly candles to wait for those manipulations so that you can then trade the trend that emerges during that distribution phase. Assess price action. Is there reason for disrespect? Is there reason for price to go lower? If no, execute, in this case, on the 12-hour time frame, targeting that higher time frame draw. My model is that I track and analyze 32 Forex pairs, including gold, silver, and Bitcoin. I track 12-hour price action in conjunction with monthly, 2 weekly, and weekly candle closures, and I just see how price is developing. Once you get good at this, you can do it in 10 to 15 minutes a day. I have a lot more coming on this, so please subscribe to the channel, and I'll see you on the next one.